Hello everyone, I'm Noah Lui, RHB Bank's Head of Investor Advisory. Welcome to our Money Chat series. We are at the very important turning point on the interest rate cut cycle, which Federal Reserve Chairman Jerome Powell have well signaled that the time has come, hence ending the moment of higher for longer era. What are the asset class that will benefit in the interest rate cut cycle? Or would it be priced in by now? Today, we are honored to have a few speakers joining us to cover a few assets that has been on hot discussion on where and when to invest during this pivoting moment. Firstly, please welcome Toon, Chief Investment Officer of RHB Asset Management Singapore.
Thank you, Noah. Very happy to be here today.
Thanks for joining our Money Chat series again, Toon. The mega cap technology stock has been in the forefront of global equity gains. Toon, do you think the upcoming interest rate cut cycle will trigger a sector rotation?
For sure. The interest rate cut cycle would typically trigger a sector rotation. I think this would especially be so because this is a major regime change, especially after the aggressive interest rate hikes that we have seen over the last few years. However, rate cuts are generally related to a slowing economy. As such, defensive sectors such as consumer staples and utilities should perform as we enter into a rate cut cycle. These sectors are typically more resilient in terms of earnings and dividends. However, as the economy starts to recover, we should examine the industrial as well as the material sectors, which can benefit from lower borrowing costs. Similarly, a lower interest rate would benefit the technology sector due to lower discount rate for future earnings, as well as the real estate sectors through reduced borrowing costs. However, I would also like to point out that the mega cap technology stocks are currently running on the artificial intelligence or AI theme, which is independent of the interest rate cycle. We believe that the AI theme is a structural growth story. However, I think investors would need to be careful as valuations may be too high in view of a slowing economy.
What about in terms of the market cap perspective? Lower interest rate has seen as a beneficial for the smaller cap companies, which generally have higher level of debt than the bigger ones. Is it a good opportunity for our investors to jump into the smaller cap growth stocks now?
So typically, lower rates should benefit smaller companies because of their higher leverage level as well as their lower interest coverage ratio. The lower borrowing costs would support smaller cap growth stocks to fund their growth to attain their higher growth potential. In terms of fund flows, investors might rotate into these smaller companies if the big cap companies are seen to be overvalued. However, if the interest rate cuts are due to growth concerns, then smaller cap growth stocks may underperform as they may find more difficult to grow. In this scenario, quality would outperform growth.
Especially when it comes to the Asian market, financial sectors, actually including the world market also, is one of the bigger sectors that investors have exposure. Interest rate cut cycle typically impact the bank's net interest income margin. Will the profitability of the bank impacted in the foreseeable future?
In an interest rate cut cycle, net interest margin on NIMs should be compressed. However, banks can mitigate this impact through their lower cost of funds, although it will be with a time lag. On the other hand, with lower interest rates, hopefully loan growth may pick up for the banks and thereby lifting net interest income. Additionally, over time, asset quality should improve in a rate cut cycle. With potential credit cost easing, banks' earnings and ROE should improve.
Emerging market may be lagged in the cutting interest rate. Does it mean that any positive hike from the interest rate cut may not be relevant to the emerging market?
Currently, with concerns over foreign exchange or FX stability, emerging market might be a laggard in cutting interest rates. However, with the likelihood of US Fed policy rates cuts beginning in late 2024 having increased substantially over the last few months, some emerging market central banks are more willing to take an earlier cut. Indeed, with the recent weakness in the US dollar, it has opened up a rate cut window for countries like China and Philippines to cut during this period of time.
When it comes to interest rate cut, fixed income asset, especially bond, is likely the highest beneficiary from the potential interest rate cut. Do you think the dividend stock may potentially enjoy the same benefit?
With interest rates falling, bond yields would decrease as well. This makes the relatively higher yields offered by dividend stocks more attractive to bond yields. Dividend yield stocks offer a better income alternative when bond yields are low. In addition, there will be opportunities for potential capital appreciation and better inflation protection. However, it is important to identify dividend stocks that are able to maintain their dividends even under challenging economic conditions.
Thank you very much, Toon, for your sharing. That is Toon, Chief Investment Officer from RHB Asset Management Singapore. Moving on, I would like to extend our discussion. Joseph Magai from Manulife Asset Management joining us all the way from Boston, US. Hi, Joseph. Nice to see you again.
Nice to see you again. Thank you.
Thank you for joining us today, Joseph. We have spoken earlier in this year in our earlier Money Chat series, which has also talked about the hype on the potential interest rate cut, which by now would be crystallizing soon. Global risk index has rebounded recently following expectation on the easing monetary policy, however, remains flat for this year. Joseph, REITs are known for their distribution per unit or high dividend yielding stocks. Would demand for REITs increase in an interest rate cut cycle environment? If yes, please elaborate more how interest rate cut would benefit REITs.
We definitely believe the shift in interest rate policy by central banks to now taking an easing and cutting interest rates is a positive for the REIT sector. First, with yields coming down, the cost of refinancing existing debt, or if they're looking to go out in the capital markets to get new debt, the cost will be moving lower. And that should alleviate some of the pressure that REITs have seen over the past couple of years, where the impact of rising interest rates have had an impact on earnings as well as negatively impacting distribution rates. We now think that will be less of an issue going forward with continued improvement in real estate fundamentals. And as interest rates move lower, it acts as a stimulus to the broader economy, therefore resulting in greater demand for commercial real estate, which should support occupancy and rental growth. As a result, this should lead to improved financial results and a resumption of broader dividend growth within the sector. Also, as a result of the shifting interest rate policy, the REIT sector performance, as you mentioned, has recently improved over the last few months as some central banks have cut rates and further indications here in the US that the Fed is now going to begin cutting interest rates. We have seen the sector perform well. And historically, as interest rates have moved lower, the sector has also performed better. So it's not surprising to see the improved performance as investors begin to allocate to the sector in anticipation of lower rates. And lastly, as bond yields and cash rates move lower for investors, they will likely look to other alternatives for the yield and income. And we believe REITs will see increased demand given their current attractive distribution rates and their ability to grow them over time.
Thank you, Joseph. Is there any areas of the subsector within REITs will benefit most from the global interest rate cut cycle?
While the sector as a whole will benefit from the reduction in interest rates, some sectors do initially perform better than others during the initial periods of interest rate cuts. They tend to be the healthcare REITs, data center and tower REITs, as well as the net lease subsector. They tend to lead the way as they perform better in moderating economies and are considered more defensive given their longer lease nature of those subsectors. But performance from retail, industrial, and residential sectors also perform well historically when interest rates are lowered, as the interest rates policy changes by central banks tend to spur more economic activity. They are looking to increase economic activity in their particular economies, and thus that improves the labor markets and includes increasing wages. Ultimately, consumer consumption goes up, business investment goes up. So all those factors lead to a demand for more commercial real estate. And so we believe that those subsectors will perform well during the time periods when interest rates move lower. But ultimately, real estate fundamentals still play an important part of what drives these returns. So we have to examine each of those subsectors accordingly to know exactly how the fundamentals will behave as interest rates move lower and allocate accordingly.
So we've spoken a bit about the allocation and the preference within a different subsector in the REITs. But what about within the geographical focus? Within your portfolio, do you have any preference between global or Asia REITs for the time being?
Well, the one thing we definitely encourage investors is they should evaluate and consider owning REITs within their overall investment portfolio. We believe that both global and Asian REITs provide a diversification benefit to an overall portfolio, and the asset class has a strong history of providing both income and capital appreciation over the long term. Now, when choosing between a global or a regional focus, such as an Asian REIT fund, we believe there are advantages of investing in a global fund, as the economic conditions, real estate fundamentals, valuations, and even investment opportunities can vary across regions as well as over time. And that a global portfolio enables an investor to not only gain that exposure from a broad reach of global REITs, but also gives us as managers to be able to target those attractive markets and subsectors for our investors. And based on our current outlook and the current valuation, we prefer the US, Australia, and Singapore REIT markets. We like the healthcare, data center, tower, and industrial subsectors. And where we're more concerned, or we see less investment opportunities in the current environment, is within Hong Kong and UK REIT markets, as well as in the residential and self-storage markets. So we definitely encourage investors to consider REITs as part of their portfolio. It provides them excellent diversification benefits, as well as, in our view, an attractive entry point given the current economic environment, as well as the shifting policy within interest rates.
So far, our discussion has mainly biased towards the catalyst from the interest rate cut. Joseph, do you see any other catalysts that may potentially drive REITs prices higher?
While we do agree that the change in interest rate cycle is a significant catalyst to support the sector moving higher, we also see other potential catalysts such as dividend growth, merger and acquisition, and improving real estate fundamentals that will support the sector's performance. And so as central banks continue to move to an easing policy, whether it's the US, the European Central Bank, Bank of Canada, Bank of England, et cetera, we believe those central banks are taking necessary actions to help stimulate their local economies, and ultimately will lead to stronger real estate fundamentals. But when in regards to dividend growth, that will definitely be a beneficiary of that improved economic activity, as well as the easing of financing costs as a result of lower interest rates. So we'll see less pressure on REITs' financial results, and ultimately dividend growth should improve. In regards to merger and acquisition, we believe the sector trades at a very attractive valuation when you look at where the REITs are trading at compared to their respective net asset values, or when you look at where the valuation is compared to the broader equity markets. There is still significant capital that has been raised and is on the sidelines, being held by either sovereign wealth funds, private equity, or institutional investors that will look to invest in commercial real estate. And given that interest rate environment is also easing, it's also freeing up more capital to be lent out to these institutions. So we believe that there's potential, if valuations remain this attractive, that M&A activity will increase. And lastly, real estate fundamentals, as a result of the lower interest rate environment, as we talked about, stimulating local economies, improving business investment, improving labor markets, and improving consumer consumption, will ultimately lead to stronger demand for commercial real estate. But one of the things that has impacted the sector and is now going to be a positive as a result of the higher interest rates was the sharp decline in new development of real estate. Not only were the costs of raw materials that go into a new development moved higher as a result of inflation, but the lending for development also dried up as banks were unwilling to lend in this environment, as well as the cost of financing became very expensive. So we believe that on the supply side, there'll be less risk to the REIT's real estate fundamentals, and that will thus present better financial results supporting occupancy growth and rental growth. And so we believe in the current environment, with the current valuation, the global REIT sector looks very attractive for investors.
Thank you, Joseph, for your sharing. Appreciate it. Dear investor, I trust that the first two speakers have spoken a lot about the prospect of equity-relevant investment that can be positioned in your portfolio. The discussion now turns to a critical topic, which is the fixed income instrument, particularly bond, which is closely linked to the interest rate movement. When interest rate decrease, bond price typically rise. However, the market has already factored in a reduction of over 100 basis points by end of this year. Is there a possible growth in this asset class? Let's get the insight from Terry Taglinon, Managing Director and Head of Fixed Income Business Development at AllianceBernstein, based in Hong Kong. Thank you for joining us again today, Terry.
Thanks for having me.
Hi, Terry. The expectation for interest rate cut changes dramatically this year from 1 time to 7 time interest rate cut. What about your view? How many rate cuts do you expect from the US Federal Reserve, and how do you position your portfolio on the potential rate cut?
Well, first of all, the direction of travel is very clear. Interest rates are going to go down, but the timing and the magnitude of rate cuts will depend on the economic picture. So I expect about 3 cuts for 2024 and likely more cuts in 2025. So with inflation now being out of the way, or almost out of the way, the Fed is going to really closely watch the growth data and the labor market. So talking about the labor market, the US unemployment rate had gone up a little bit to 4.3%. But remember, this has been driven more by an increase in supply of workers, especially non-US workers, rather than a decrease in demand from companies. So clearly the economy is still resilient. So we expect a soft landing. That's our base case scenario. We do not expect any recession anytime soon. In terms of our global portfolios, we've been positioned with a longer duration bias, so more sensitivity to falling interest rates going into the summer. So we've been gaining in those long duration portfolios relative to the markets. At the moment, we're a little bit more tactical. The 10-year Treasury yield is hovering around 4%. So we are a little bit more tactical at this point in time.
Since the bond has performed well so far this year ahead of the interest rate cut, would it be too late for investors to jump into bond now?
Well, it's a great question, but as investors, we're constantly reminded that staying invested and staying diversified remains the best long-term strategy for your portfolio. So there are still plenty of juice left in the bond market, especially when we adopt a multi-sector active balanced approach between credit markets and interest rates. So yes, credit spreads are really tight. Valuations are a little bit expensive, a bit tight, but the fundamentals of credit markets remain very sound, and technicals are also supportive. Let's not forget that if I look at the US markets, there is about over $6 trillion sitting in cash in money market funds, according to Morningstar, in the US market. So when the Fed cuts and other central banks will cut interest rates, cash deposit rates are going to fall. So naturally, you're going to have this wall of cash, over $6 trillion in the US, being redeployed into high quality bonds. That's why I'm very constructive and very optimistic about the bond markets in the coming years.
So like what you said, there is still a prospect for investing into bond. So in Malaysia, we have a few types of fixed income investment, including global, emerging market, and also Malaysia. So what's your view on the fixed income market comparison between emerging market and the global market? Is there any market that you prefer?
Yeah. So we've been overall very cautious on emerging market bonds. Why is that? Well, the US markets have done really well, right? But typically when we look at EM, or we look at the structural part of EM and the more cyclical part of EM. So within the structural part, we tend to favor hard currency or US dollar denominated EM corporate bonds. If I look at Latin America, for example, we invest in national champions, so very large companies in key sectors such as banking, telecoms, utilities, in countries such as Mexico and Brazil, for example. More recently, we've been starting to dip our toes into the local currency EM markets on the back of a weaker US dollar environment. So within local bonds, if I look at our Asia portfolios, we've been overweighting Indonesia and India, for example. In India, we have been a pioneer in buying into India government bonds ahead of their inclusion in global bond indices. Elsewhere, we've been a little bit more tactical in markets such as Malaysia and China. For example, in China, yields are fairly unattractive at this point, even though the central bank is going to cut rates further. We see more opportunities in India and Indonesia, as I mentioned just now.
That's great. Lastly, Terry, what would be your last 3 investment tips for investors for the rest of the year?
Well, as we enter a soft landing economic environment, being diversified and balancing risks between credit markets and interest rates is going to be critical, right? So you want to keep this multi-sector balanced fixed income portfolio. So number one, stay calm, right? So the Fed is going to cut rates. You want to own duration. So be more sensitive to the fall in interest rates. So that's why keep a long duration bias. In my view, that's going to be rewarding. So just be patient, but be prepared because cash deposit rates are going to fall. So you do not want to be stuck in cash deposits ahead of a Fed becoming more accommodative and cutting interest rates. Number two, avoid taking too much risk, right? Especially in cyclical sectors. If we enter a softer environment, you want to be exposed to more defensive sectors. And lastly, if I look at the broad portfolio that includes stocks, real estate, bonds, I like to favor the short-dated, high-yield bonds, especially in defensive sectors, as an alternative to stocks, especially if the economy deteriorates from here.
Dear investors, I hope you have gained better insight and able to make better informed investment decisions after hearing from all our panelist speakers today. Thank you for your time, Terry.
Thank you.
Equity strategy that may benefit from interest rate cut includes the lack of dividend-paying underlying, equity premium income, and other income-paying equity strategies. Technology and artificial intelligence is a structural growth story. Within the series of technology sector, there are funds which may vary on its mandate, including its allocation between major and small cap companies. There is also option for clients seeking for diversification in smaller cap equity market in Malaysia. Extending from equity strategy that potentially benefiting from interest rate cut is REITs fund. Meanwhile, at RHB Bank, we distribute many other fixed income funds for your consideration. Please engage our relationship manager to know how your portfolio can be repositioned to optimize potential return for your investment.